Hey everyone, welcome back to AI Explains ICT. Today, we're diving into some really powerful stuff from core content, specifically Month 11, Episode 4. So you might want to grab a pen and paper because we're going to be talking about one of the biggest opportunities ICT covers, how to hunt for those absolute mega trades in the bond market.
So, here's what's on the menu today. First up, we're going to talk about a really cool repeating seasonal pattern in bonds that can give you a serious edge. Then, we'll get into the nitty-gritty of how to spot smart money's footprint, the real confirmation. After that, I'll lay out the exact process step by step. And to prove this isn't just theory, we're going to look at a whole decade of trades. And of course, we'll wrap it all up with the key takeaways you can actually use.
All right, let's get right into it. The foundation of this whole strategy, the thing that makes it all tick, is a recurring pattern. And believe me, this pattern can give us a pretty significant statistical edge, year in and year out. So, here's the big idea. Based on ICT's deep historical analysis, the 30-year Treasury bonds, they have this incredibly high probability of putting in a major, and I mean major, tradable low sometime between May and June. And look, we're not just talking about some little blip on the chart. This is often the launching pad for a huge rally that can run for months.
Okay, but, and this is super important, ICT really hammers this point home. This is a tendency. It's a statistical edge, not a crystal ball. It is not a guarantee. You can't just blindly buy bonds on June 1st and expect to make money. That's just gambling, right? All this pattern does is tell us when to really start paying attention. The tools we're going to cover next, those are what tell us if it's actually time to pull the trigger.
So, if the season is like our calendar appointment, telling us when to show up, how do we actually know the party started? How do we confirm that the big players, the institutions, are really stepping in? Well, we have to look for their footprints in the market.
And this is what ICT calls the silver bullet for this entire setup. It's our #1 confirmation tool. It's what validates that seasonal tendency and gives us a huge clue that large institutions are probably building their long positions. And it's called interest rate SMT divergence.
So what in the world is that, right? Well, think about it like this. Normally, in a healthy market, the interest rates on different treasury bonds, the 5-year, 10-year, and 30-year, they all kind of move in sync, like they're holding hands. But when smart money comes in with these massive orders, they don't just dump it all in one place. They spread it out. And the sheer size of their buying can actually break that harmony, creating what ICT calls a crack in the correlation. And that little crack, that's the footprint we are hunting for.
Okay, so to actually spot this, we've got to have our eyes on 3 specific charts. We need to watch the 5-year note, which gives us that short-term picture. Then there's the 10-year note for the intermediate view. And finally, the 30-year bond for the long-term perspective. The whole secret is watching how these 3 dance with each other. So here's the signal, plain and simple. As prices are heading down into that May-June window, we're watching these 3 yields like a hawk. Now, imagine the 10-year and the 30-year both make a new low, but the 5-year just doesn't. It fails to make a new low, and instead it actually prints a higher low. Boom. That's it. That's our signal. That's a bullish SMT divergence, and it's a screaming sign that the selling pressure is drying up and a reversal could be right around the corner.
Okay, so we've got the timing from the seasonal pattern, and we've got our confirmation signal with the SMT divergence. Now let's stitch it all together into a simple, repeatable process that we can use to hunt for these trades every single year.
All right, here's the annual game plan. It's a 5-step process. Step 1, we start anticipating that seasonal low as we head into May and June. We're not acting, just watching. Step 2, we have to be patient. We wait for the price to drop into a key discount area on a higher time frame. No chasing. Step 3, now we start our daily work. We scan for that interest rate SMT divergence between the 5, 10, and 30-year yields. Once we spot it, it's go time for step 4. We frame our entry using all the institutional concepts we know. And finally, step 5, what's our target? We target the fall months, usually September or October, for a big intermediate term high to form. Simple as that.
Now, all this sounds great in theory, right? But the real question is, does it actually work? Like in the real world? Well, let's put it to the test. We're about to walk through 10 straight years of historical examples that ICT provides to see for ourselves.
First up on the docket, the year 2008.
So check this out. In 2008, the 30-year bond puts in a major low right on cue in June. And right at that turning point, what do you think happened? A crystal clear SMT divergence popped up between the Treasury yields. That was the green light, the signal to start hunting for a long entry. And the result of catching that setup?
The move from that June low into the September contract was worth a staggering $12,000 per contract. Now that is what we call a mega trade.
All right, let's keep this train rolling. Next stop, 2009. Okay, June 2009. This was a textbook example. You had the 10-year and the 30-year bonds both pushing down, making fresh new lows. But the 5-year, it refused to go along for the ride. It showed its strength by putting in a higher low. That, my friends, is the exact crack in the correlation we're looking for. It was a beautiful signal for a prime buying opportunity.
And the profit potential on that one? Well, if you combine the initial pop and then rolled over into the next contract, ICT's analysis showed a potential move of about $11,500 per contract. I mean, come on. Another incredible year for this model.
Okay, now it's time for a reality check, because this is really important. This is not a magic 100% win rate system. So let's talk about 2012 and 2013, which ICT points to as dud years. Years where that classic mega trade just didn't happen.
So what happened? Well, in 2012, a signal did actually form, but the rally just fizzled out. It was a pretty small move, maybe $5,000, before it rolled over. But 2013 is the really important one here. In 2013, bonds were just getting hammered. They were in a massive downtrend. And guess what? No bullish SMT divergence ever showed up in that May-June window. And that's the key lesson here. If the setup isn't there, there is no trade. Your discipline to sit on your hands is just as important as your ability to pull the trigger.
I mean, when you lay out the data over a full decade like this, it's pretty hard to ignore the power of this approach. Look at that. Out of 10 years, this model flagged a high probability setup 8 times. You've got winner after winner, with a bunch of them being those strong winners that brought in way over $10,000 per contract. And, just as important, look at 2013. The model said no trade, which protected your capital. The consistency here is just, it's remarkable.
All right, so we've covered a ton of ground. We've talked about the concept, the confirmation, the step-by-step process, and we've even looked at the historical proof. So let's boil it all down into a simple checklist you can take away from this.
Okay, let's lock this in. Here's your final checklist. First, every single year, circle May and June on your calendar. That's your window for a potential major low in bonds. Second, your confirmation tool, your silver bullet, is that interest rate SMT divergence between the 5, 10, and 30-year yields. Third, when you see that divergence, that's your big hint that smart money is probably stepping in and accumulating. Fourth, remember that this big picture bias can be used to frame all kinds of trades: position trades, swing trades, even day trades. And last, but definitely not least, patience and discipline are non-negotiable. Not every year is going to be a home run. Sometimes the best trade is no trade at all.
You know, this is just such a powerful framework because it's not random. It's built on a logical, repeatable market tendency that ICT has pointed out. So the only real question left is, now that you know this pattern, what are you going to be looking for when spring rolls around next year? I really hope you got a ton of value out of this video. If you did, do me a favor and hit that like button, and be sure to subscribe to the channel so you don't miss the next one. Of course, if you have any questions at all, just drop them in the comments below and a real human will get back to you. Until next time, good luck out there and safe trading.